the truth is, I've never felt that self-confident all these years. So here I am as a Nobel laureate. I don't still believe it. Maybe you believe it. But, I decided here, this was billed as a reprise of my Nobel lecture. And so I thought, what is a reprise exactly? It actually comes from the French musical notation, bar de reprise. That at the end of a stanza, you'll see two little dots, and that means go back and sing exactly the same thing again. And so I guess that's what I'm supposed to do. But I can't sing it exactly the same. But I have the same music. So this is what I decided to do. I have no notes here. I just have that. And that is exactly the same slide presentation that I used on December 8th. I started to revise it, but then I found myself making too many changes, and it wasn't a reprise anymore. So this is my discipline. Now, there's a problem here, too. I talked with other Nobel laureates about preparing. This is supposed to be a summary of my work for won the prize. And it's scientific. You know, the Nobel Prize is for a particular scientific accomplishment. And that means it has to be kind of high level. First of all, that's very difficult because I did a lot of this stuff 30 years ago, and it's not on the tip of my tongue anymore. But it's also hard to make it appeal to audiences today. So I went to Jim Rothman's lecture at the medical school. He's the other Nobel laureate this year, and I was inspired by his lecture. He brought it down to earth. I more or less understood what he got his medicine prize for. And so, but still I had to keep it somewhat highbrow. So see how I do with this audience. This audience, I think, is a broader, a more technical audience than I had in Stockholm. Probably, I had the general public there. So we had our thing in the Aula Magna of Stockholm University. And I was the third of three economics laureates. The first one was Eugene Fama from Chicago, and the second one was Lars Peter Henson, also from Chicago, and then me. And I was sitting in the audience looking around at the audience while they were giving their talks. And I detected a look of puzzlement on people's faces. And especially Lars, I think I got different advice. Someone said, you should use this opportunity to do your latest work. I think maybe that's what Lars did. It was new, and I couldn't understand it either, what he said. I knew the audience wasn't getting it. So I thought, I'm going to go through these slides, and I'm going to paraphrase them and not get into too much of the math. So maybe that's what I'll do here again. But I do start out with some math. But you people here know that equation, right? That is the present value equation. It says the price of an asset is the expectation of P star, where P star is the present value of its future cash flow. I'm using D for cash flow because I'm talking about a stock, the dividends on the stock. So the price is the expected present value. Now, economists today think expected present value is the same as the optimally forecasted mathematical expectation. We have been living in an efficient markets world where we just assume that everything is optimal. The other laureate on the three of us, Eugene Fama, is the guy who started all this. So I felt kind of uncomfortable. In 1969, he wrote a famous paper in the Journal of Finance called Efficient Capital Markets, a Review. And he coined the term efficient markets. Now everyone believes markets are efficient, which means they're smarter than any individual. The markets, maybe some people here believe this. I shouldn't smile. Eugene Fama talked about bubbles, and he had it on his slide. One of the bullet points was bubbles, but he couldn't help snickering when he came to that word. You can see that. So we had a little edge, a little conflict, Gene and I. So I'm assuming that some of you believe in this efficient markets hypothesis. Actually, I think it's a half-truth. It's difficult to make a lot of money easily, fast. And in that sense, efficient markets is absolutely right. I kept having to explain myself that Gene and I are both scientists. People were questioning, how can you get the Nobel Prize when there's such a fundamental disagreement? So I said, no, there isn't a fundamental disagreement. Markets are sort of half rational, and we just have different ways of summarizing it. By the way, I have a New York Times column coming out Sunday describing my dispute with Gene Fama in the Sunday business section. So I'm going through this again. Gene Fama, in his doctoral dissertation in 1964 at Chicago, found that prices of financial assets were somewhat forecastable, like 1% of the variation within a month. And he said, that's so small, we can approximate that as unforecastable. And so we'll say that there's no way to beat the market. Markets are smarter than you. Don't even try. But of course, there's a little bit of forecastability. But I thought there's a different way to view it that makes it look completely different. So take this simple model, and then where the interest rate R that's discounted is constant. And let's see what it means historically. This is what I did in 1981, in what is maybe the most famous paper I've written. And that is, I took the present value for each year going back to 1981 of the actual dividends that followed those years. I published that paper in 81 using data through 1979. So this was the beginning and this was the end of my sample period back then. The problem is that stocks are infinitely alive. So I didn't know dividends after 1979. But I took the present value up to, for every year of all subsequent dividends that I knew, and I made an assumption about dividends after 1979. Now I've updated that. So the blue line is the actual real S&P composite stock price index, and the green and red lines are what they would have been, according to this model, if people knew the future perfectly. Now, unfortunately, I still don't know dividends after 2013 when I did this one. So I used two different assumptions. One is that the growth rate of dividends is the same as it was for the last 10 years, that's 2003 to 2013, or that it was the same as what it was for the last 30 years. And I get two different P stars, or present values. And now what you see, am I being clear enough? This is still, what you see is that the actual stock price jumps around a lot relative to the present value. The present value is just growing like a trend. I can embellish that a little bit. Look in 1929. You see this peak right there in 29? And as you may have heard, the market lost 85% of its value. Well, look what P star did. It went down just a little bit. If they had known the future, according to this model, they wouldn't have marked the stock. You might have marked it down so much. You might think that, well, the depression hit, so didn't that hurt the value of the market? No, it didn't. Dividends just went down a little bit. They just sailed through the depression. You've probably read too many stories about it that exaggerate it. The big thing that happened was in the markets that overreacted to the depression. And you see a lot of what I thought was overreaction. So this plot, I think, did a lot to, I have to watch my time. I can go on like this with this diagram. This got me in a lot of trouble because I was accused of oversimplifying and presenting misleading information. But this is just what it says it is. This is the present value of dividends and the stock market. And I just posed it as a question. Why is the stock market going up and down so much? So I got a lot of critics in the 80s, 90s. They're still happening. They're still coming in somewhat. But the picture kind of speaks for itself. What were they thinking? I actually have a plot of dividends from 1871 to 2013. Real dividends. Everything's in real terms. And it looks like it has a pretty good, pretty stable trend, right? It's a lot of short-run fluctuations. But the growth rate doesn't seem to have changed much in almost 140 years. It grew a lot. It's grown a lot in the last 10 years, you can see. But over the last 30 years, not so much. So I just kind of think it looks trendy. And that what is the market doing? Well, economists think, though, and this is something that both of my other colleagues, Fama and Hansen, emphasize, is that there are other models, other efficient markets models. So I'm writing a couple other present value models. This one says price is the expected P star discounted by time varying interest rates. And this is the time varying actual 1 year interest rate that I use to discount the annual dividends. And the other one is, this is something that Robert Lucas and others have invented, that the price is the expectation of another P star that's discounted by a time-varying discount factor related to consumption. And there were a bunch of papers in the 70s and early 80s about this, and it still goes on. Lars Hansen talked about this model in his talk. But if you look at these, I can compute all these present values because I have data from 1871 to the present. And none of them seems to, they don't show enough volatility generally. And they don't show much correlation with the actual stock market. So, you know, like for example, if you discount the dividends by the current interest rate, the stock market should have been extremely high in the Great Depression because interest rates were very low. But it wasn't really high. So the conclusion I got is that, well, the efficient markets model looks good in the sense that Fama emphasized it, that returns, it's hard to make money fast. I still don't know how to make money fast. I'm still teaching economics, and I'm not a billionaire. But that's a different thing to say that markets are perfect. So I propose tests of excess volatility. Leroy and Porter and others did this as well. And I tried to argue that the statistical theory suggests that these tests may be more powerful than the kinds of tests that people were doing. In a sense, what people were doing after Fama was repeating the same obvious fact. Of course it isn't easy to get rich fast by trading day to day. Of course day-to-day prices must be almost unforecastable, just because we know that it can't be easy to make that much money that fast. The interesting thing is what really is driving the market, and that was exposed as something that's not understood, even today, I suppose. Now, my student here at Yale, John Campbell, well, we wrote about a dozen papers together on this. But after that, he then went on with John Ammer, who was his student at Harvard, and they did this decomposition of the innovation in excess returns. So I didn't explain what this meant then, and I'm not going to now. But the basic conclusion was they did a decomposition of variance for return volatility, and they found that most of the volatility was associated with predicted excess returns in the future, and not to dividends or to one-period interest rates. So that kind of confirmed what we had. Now this leads back to a theoretical story that I date back to John Maynard Keynes in his 1936 book, The General Theory of Employment, Interest, and Money. And it's motivated a lot of theoretical literature since. So what Keynes said is that the stock market reminded him of a beauty contest he saw in a London newspaper. I tried to find it by going, it's not microfilmed. You can't find it. It was some tabloid newspaper or something. But what they did is they had a page full of photographs of pretty faces. There were 100 pretty faces. And if you wanted to enter the contest, you couldn't as the face. You had to enter as a selector. You would pick the 6 prettiest faces, mail it into the newspaper, and you would win if your 6 choices came closest to the 6 most popular of all the entries. Okay? So Keynes was thinking about that. Do you understand the contest? You're just trying to guess what's most popular. He said, well, I shouldn't pick the prettiest faces. To me, I should pick the faces that I think other people will think are prettiest, right? And then he said, well, wait a minute, that isn't right either, because everybody knows to do that. So I should pick the 6 faces that I think, that other people think are the prettiest. And as he thought that, he said, that's what the stock market is like. Because you're not trying to pick the best companies, because you want to sell within 6 months or a year. You want to pick the stocks that other people are going to bid up soon. I think there was a deep insight into that. And it's not just me. There's a lot of theorists that think that something like this might help explain the excess volatility of the stock market. Now, I didn't put it on these slides, but there are other developments along these lines. Other people are thinking about what might generate excess volatility. And one of them is Nick Barbaras. I thought I should mention this, who has a theory that brings prospect theory into economics. Now, prospect theory was devised by psychologists Kahneman and Tversky. And it's a theory of human behavior under uncertainty that's based on experimental evidence, whereas the expected utility theory is not. It's been rejected. So it has to be a better theory. And in this theory, Nick and his co-authors showed that you can you can expect some excess volatility through a framing effect called the house money effect. That as the market goes up, people become less risk averse. They become more willing to gamble, and it accelerates the rate of increase. And there are other articles that come to mind. Here at Yale, we have Don Brown, who's working with Anat Bracha on an affective theory of speculation, and about the people who are thinking about ambiguity. And this gets back to a Keynesian idea that economists like to think that we have probabilities for everything. But in fact, there's always ambiguity, because the world always seems to be changing in fundamental ways that can't be quantified. So now we're getting neuroeconomics or neurofinance that are starting to discover how the human brain handles ambiguity. I think that we're not done with understanding these things. So, but the other thing is that I wanted to emphasize that I'm not so negative about financial market, not negative at all, despite my claim that psychology plays a big role in these markets, or appears to. One thing that has been discovered, now Tuomo Voltinaho is kind of like my grandson. Not really. He is the student of my student, John Campbell. And so he did the same sort of variance decomposition using individual stocks rather than the stock market. And he found that for individual stocks, the efficient markets theory works better, and that actually most of the variance is explained by news about future dividends for individual stocks. What's the difference? Well, the difference is that individual stocks, there's more information about them. You know what the management is doing, you know what their product is. Whereas for the aggregate market, it's all kind of macroeconomics. It's just nothing that you can sink your teeth into. I teach macro, by the way, but it's not so. So I think that the efficient markets model has some value for individual stocks. I tried to illustrate that graphically with my student Jiman Jung. We took this isn't really a test of efficiency for individual stocks, but it's just kind of suggestive. We went back to the CRISP tape, and we got all stocks that had existed unchanged with a complete record on the CRISP tape from 1929 to 1976. And we looked at how well the dividend price ratio for those forecast future growth rates of dividends. There should be a negative relationship. When the dividend price ratio is high, future dividends should be declining. That's why the dividend price ratio is high. People don't expect it to continue. And when the dividend price ratio is low, the dividend growth rate should be positive. This isn't the dividend growth rate. This is the present value of the subsequent 25 years of dividend divided by the price. So we can allow zero dividends. It wouldn't be an infinite growth rate. And we see a negative relationship. It's a lot of even zero dividend stocks, right here along the axis, they tend to grow a lot in their dividend growth relative to their price, as the theory would suggest. So I'm not anti-efficient markets. I think it's just reality. Academics like to have a, they love their theories and they go too far with them. So it's a half-truth. I like the way Fisher Black, in his 1984 presidential address for the American Finance Association, he said that he would define market efficiency as that the stock price is between twice fundamental value and a half fundamental value. And he said, if you'll allow me to say that the efficient markets theory says that that's true 90% of the time. Okay. Well, maybe he's not so far off. That was just his intuition. But I think that that's where we're going. But there's still something valuable about efficient markets. And I think that a lot of other things I've been doing is proposing the expansion of markets, because I think markets are a good thing, and financial markets are a good thing. Now, I wanted to talk about home prices, which is another major research effort of mine. I started working with Carl Case, who is the co-author of my co-author. I've written joint papers with Ray Fair here at Yale. And he introduced me, well, he and Sharon Oster introduced me to Carl Case at Wellesley College. And then we ended up writing a lot of papers together. But one thing we did is computed home price indexes starting in the 1980s. This is our index for the United States that we did repeat sale. We're the first people in the world to do repeat sale home price indices. Now, what is a repeat sale home price index? It's an index based on the price changes of individual homes. A stock price index is always a repeat sale index, but no one had them for home prices. Amazing. I think it's amazing. It says something about styles of research. Academic research had gotten so advanced about the stock market, and they knew nothing about home prices. But we were able to buy a tape from some appraisers showing all home sales in 4 US cities, and that's how we got started computing these indexes. One thing that we discovered was a huge boom in home prices starting after 1997. I just wanted to compare that, our index, the blue line, with one of the indexes that was already available in 1987 when we started. And that's the United States Census price of new single-family houses sold, based on the kinds of houses sold in 2005. Well, this is actually a revised version of the index they had then. What they did is that's a hedonic price index based on sales of new homes. It fixes the number of bedrooms, the square feet of floor space, square feet of lot, things that you think would matter in home prices, and it produces a price of a standardized home. But it's new homes, okay, because that's the data they had. Look at how different our index is from theirs. Ours has a huge boom going on between 1995 and 2000, where home prices doubled. And nothing much happens to their series. Well, I can tell you why nothing much happens. It's not a repeat sales series. It's new houses. And they only build new houses where they can build them profitably. And so they're never going to show a big drop. They won't build them if they fall below construction cost. And if the land is getting really expensive in the city and there's no lots left, they won't build them there. They'll build them way out, far out. And they'll just be construction costs, basically. And so it's we discovered an investment-oriented home price index. And we did it because we thought there should be markets. By the way, for home prices, the other thing about home prices is it is so much less efficient than the stock market. Look at this. It started going up. Now, that's seasonal. This is not deseasonalized. Except for seasonal, it just went up steadily on an exponential growth path until, when was the peak? 2006. And then it just went down just virtually every year for the next 8 years. That's not the way efficient markets are supposed to behave, right? They're not supposed to be so predictable. So we thought that we wanted to create markets that made them more make this market more efficient. Now, this may seem uncharacteristic of me, who's just argued that there are all these bubbles in markets, but it's what I thought, because I just want to accept the real complexity of the world. And we did create a futures market for single-family homes at the Chicago Mercantile Exchange, with the help, of course, of all the people at the CME. And we started it in 2006. Unfortunately, we started it when the housing market was dropping, and it may not have been optimal. We didn't have a huge success, but it is still going. This is a plot from a website that a market maker for the CME has called homepricefutures.com. You can see that down here, John Dolan. And it shows, as of December, the green is the futures prices. The black is the actual home prices that we saw. So what you can see is the market is expected to recover. It only goes out to 2017, but this, it looks like by 2018 or something, we should be back up to 2006 levels. But actually, the target inflation rate is 2% a year, so in real terms we'll be 30% below the 2006 peak, even in 2018. Well, we're learning something from these markets. The markets haven't become we were hoping that they would become influential enough that it would change the nature of the cash market, but that hasn't happened yet. So where am I here? Oh, this is just, there's, the way housing markets behave is already very speculative and very, it introduces a note of craziness to our lives. This is a plot of the relative price of homes in Los Angeles to a personal income index. So the level it has a scaling problem, but you can see how much Los Angeles home prices went relative to people's income. They fell in half between 1987 and 1995. Then they almost doubled. Then they fell in half again. But people are, meanwhile, making decisions about whether to buy a house, whether to take an offer at UCLA or anything. My sister-in-law almost refused an offer at UCLA to be a professor there because she thought, she looked at houses and got profoundly depressed. She was in right around there. There's craziness in these markets, in my opinion. Eugene Fama doesn't seem to agree, but we'll leave that aside. So I produced a home price index for the United States going back to 1890, and that's the blue line here. The other lines shown are building costs, a building cost index in green, the population of the United States in lavender, and then the interest rates in gray, long-term interest rates. And to me, we learned so much from this plot. The thing that surprised me is that nobody had ever plotted a long-term home price index for any country until I did this. Now, it's not the most accurate index. It's the best I could do. But it gives you a picture of, first of all, what an enormous event we just had right here, again, right up there. It was unprecedented in US history. The history before that, nobody remembers because we're not used to looking at it. There's nothing like it. There's only this thing right here, this boom. Do you know what this boom is called? I'm asking my class for, what's the name of this boom? The baby boom, yes. That's what they called it back then. They said, well, the men are coming home from World War II. They want a two-bedroom house. They don't want to keep the baby in the same room with them. And so it caused a boom in home prices. You haven't forgotten the boom, but most people don't think about these data. And so they didn't know, they didn't have perspective on what was going on here in the 80s. And that's part of the reason why the financial crisis has gotten so bad. So I think that what has happened as a result of this kind of research is that we have had a behavioral finance revolution. And this is something that is big here at Yale. Well, it goes back I have it back here on my slides as starting with Emile Durkheim in France in 1893. But actually, did you know that the first sociology course ever offered in the United States was offered at Yale University in the 1860s or 70s by William Graham Sumner, who was an economist here who was also interested in sociology. In fact, he kind of made sociology. I think that it's fundamentally relevant to understanding financial markets. Also, social psychology. Irving Janis was at the Yale psychology department. Here's where I'm different. I'm boosting Yale here. Sorry. I didn't do this in Stockholm. But I did have the same slides in Stockholm. Irving Janis wrote a remarkable book in 1971 called Groupthink, about how organizations get confused. Now we have organizational behavior. It's developing into a whole science. But organizations of experts can mess up, and that helps explain why the financial crisis got as bad as it did. People are always asking, why didn't the experts see it coming? Well, I think you have to think about groupthink to understand that. Then there's selective attention. William James, Christopher Sims, rational inattention. We don't have time to pay attention to everything that's relevant, so we don't. The news media are phenomena that are extremely important for understanding the stock market, I believe. It's an amplifier of social epidemics. And lots of things are relevant, even population biology. Richard Prum, now at the Yale biology department, is writing a book that was relevant to finance. He sees evolutionary biology and analogies. Epidemiology in the medical school is about how diseases spread, and I think that same thing is relevant to how bubbles form in markets. Neuroeconomics is coming into focus as an important field. We have a number of people here at Yale who are interested in that. I think I'm just about done. I just wanted to say at the end that I just believe in looking at the real world and not idealizing it. So it's not perfect. People are a social animal. They're very amenable to suggestion. They can make big mistakes. History is filled with examples of that. And yet, financial markets will reflect those mistakes, and they won't do things exactly right. But on the other hand, what we've learned in history is that financial markets are, they seem to be associated with success and prosperity and freedom and self-expression. They're associated with some negative things as well, but most people in the world are interested in participating in financial capitalism. I closed in my lecture, this is exactly what I showed then, with my book, Finance and the Good Society, which was published last year. But I didn't want to make too much of it because they didn't mention it in their scientific background. So I didn't know if they liked that book. But I thought I have to say it because I believe that finance is the infrastructure for our civilization. It's about achieving goals. It's also organizations. So I like the original name for the School of Management, School of Organization and Management. I like that because management, the word management sounds like it's coming down from the top. And organization, it sounds like we value the top guys, but we value everyone in the organization. And it's part of how it all works together. So the good society is a society in which we have organizations that do things that we believe in and that coordinates our activities. That's what management is really about. And I believe in that, even though I also think that it's not always going to work right and there's going to be craziness. I'll stop with that. We have questions?
Thank you very much, Bob. So yeah, we do have some time for questions. So really any questions you might have inspired by the talk, real estate markets, stock markets, Bob's relationship with Gene Pharma, but really anything else beyond that, I'm sure Bob would be willing to take quite a broad set of questions. And there are some microphones around the room, so wait for us to bring the microphone to you.
Okay, I'm going to ask a question.
Okay. Even you have to wait for the microphone.
So Nick, you prompted me by suggesting I could ask a question about Professor Shiller's relationship with Professor Fama, whom I also knew in my old job.
Oh, yeah, you must have known him.
So, and I'm already looking forward to Sunday to read about your evaluation of the dispute. But you mentioned one area where you agree, which is the everyday person. It's very hard for that person to make a lot of money fast by investing. And I've heard Professor Fama say also that if you're an everyday person, it may also be hard to find somebody really smart, like you or Nick or Shane here, who's sort of a guru, possibly, and pay them and have that work as well. But I haven't heard you weigh in on that topic. Even though markets are inefficient, can I get somebody who's maybe smarter than me to help me?
Right. There's a lot of issues here. One of them is you might think that the smart money would be able to extract all of the benefit from their being smart. Right? It's a competitive world. Everyone wants the smart money, and so they bid up their fees. There's limits to that. So Andre Schleifer wrote a famous paper showing that the problem is that people can't prove they're smart. And well, that's what you're saying. And that it takes, they try to prove they're smart by their track record. But it takes 30 years or 50 years. No one knows whether it was chance or not. And after 30 years or 50 years, you might have lost your competitive edge. And just by then, you've proven it. So there are problems. Now, when you bring up Fama, I hope I didn't make an enemy of him, because he seems to be an easygoing guy. I think we're still friends. But I was doing this. It was a whole Nobel week, and I kept being paired with him in front of different groups, including a high school, inner city high school. I didn't argue with him there, but everywhere else I argued with him. And I kept bringing up dimensional fund advisors, which is his student, David Booth, founded it, like, was it 30 years ago? A long time ago. And Booth Booth applied Eugene Fama's principles to investing and was very successful. In fact, DFA now has assets under management of about $350 billion, I think, which makes it a major investment fund. They've done that because they're so successful. By the way, also, David Booth wanted to make a gift to his, maybe you were dean when this happened. I'll rephrase it. Ted Snyder was very persuasive and got David Booth. Now, by the way, I met David Booth at the Nobel event. He was there. Everyone was, all of our close friends were there. But now, I think David told me, if I remember right, and I'm a little confused. So many things happen. I think he said that he wanted to name it the Fama School. Maybe you don't want to, at least he thought of naming the Chicago Business School the Fama School. But then they didn't like it, naming a business school after an acting professor. So I said, okay, name it after me instead. I don't know if I got the history exactly right. But DFA is one powerful success. Now, Gene kept coming up to me. He tried this for a while, and he found that it didn't work. He said, Bob, if you're so good at identifying bubbles, I want you to tell me when it's going to burst. But my retort to that, which I perfected over the days, was to say, what are you looking at me for? You did it. The DFA investment strategy is partly a value investing strategy. So they can identify underpriced stocks, and they're doing it all the time. I didn't say that I can identify exactly when a bubble would burst, but yeah, the whole bubble theory suggests you should do something like DFA. By the way, I wrote this in a New York Times op-ed for the Sunday business section last December, and I put in an original line saying, well, I even recommend DFA to investors. So Gene and I are on the same wavelength. We just invested differently. But then I called my editor and I said, I think I shouldn't be recommending investments. But then my editor said, no, that works really well. So he put it back in. So I don't know. But I actually do believe in Gene Fama. And he's a smart, quantitative guy. He just has a sort of ideology that's associated with Chicago. And, but smart people can survive ideological biases and do much the right thing anyway. So
Okay, I think perhaps we've exhausted the topic of Bob Shiller and Gene Fama. Perhaps there's a question on a slightly different topic. There seems to be a question at the back there.
Professor Shiller, do you have an opinion on how high-frequency trading affects volatility?
Okay, well, high-frequency trading, we often talk about something like millisecond trading. Well, I don't have my instinct is that it really doesn't matter one way or another. But I can't prove this, because of course it has psychological effects and everything to it. But I met one trader who told me, he said, well, it's like we used to use slide rules and now we use calculators. So it used to be that you had to get your trade in within a few minutes, or maybe a minute, okay? But now it's millisecond, and now we have a computer program, but it's all the same thing. He said, it hasn't changed. And so that's also, tell me if I'm wrong, there's no billionaire who made it by high-frequency trading, is there? Who?
Simon. Renaissance. Rentec.
Okay, maybe I'm wrong on that. There's one. $1 billion isn't much these days.
Other questions? There seems to be one over there.
Yeah, thank you for the speech. And what do you think are the impacts of like Bitcoins, crowdfunding, and peer-to-peer lending on the financial markets, on society, in the sense that we can view the Bitcoin as a new currency, and crowdfunding as a new kind of Wall Street, and peer-to-peer lending is kind of new commercial banking system. Thank you.
Bitcoins I think of as a bubble. But it's actually, there's some interesting encryption technology that underlies it. But and it's just people getting attracted to it because its price is going up. I'm going to have to speak at some event at the World Economic Forum next week. So I'll have about Bitcoin. So I have to brush up better on understanding just what's happening. But there's another theory that it supports criminal behavior because it allows anonymous transaction. But then people are telling me that, well, not really, because it's not foolproof. So, or maybe people thought that you could be a criminal using it. Crowdfunding, I have a very different opinion of. I think it's an interesting experiment that I don't know the outcome. But there's so many things happening that look like the beginnings of crowdfunding. Websites that allow you to, in effect, invest. Now, securities law has prevented them from really developing because they're worried about abuse of small investors. But you can get on websites that allow you to make loans to small farmers or to invest in a movie. The way it would work is someone would propose an idea for a new motion picture, and you could give $25 or something toward it. And then you'd be invited to some after-theater party or something if it launched. So it was basically a gift. but this kind of website might really transform into something big and important. So the Jobs Act in 2012 is trying to make it possible. So I think these are examples of innovations that Bitcoin is an experiment that I think is not very far along toward improving society, but crowdfunding is more interesting. And anyway, we don't know the future. One thing that I talk about in this book is that innovations are hard to predict. And but we have to keep experimenting. That's what you people will be doing, right, when you get out of here.
So, yeah, question over here, please.
Thank you, sir, for being here. Do you think it's worth betting one's career on stock market investing? What's your advice?
Well, we all have to do different things. So, that is a important career, I think. That we see the importance of it here at Yale because David Swenson has increased our endowment from less than $1 billion when he came here in 1985, I think it was, to it was $20 billion in June of last year. That's a huge advantage to Yale. Now the question is that just luck? And I don't think so. I think markets are not efficient, and people who are hardworking and smart can do well. But it's maybe there's some luck involved, and there's a big unpredictable element. So I just think, yeah, it's one important. I tell my students, I teach undergraduate finance, and one thing I show them is that finance has a lot of jobs, a lot of opportunities. There's a lot of people who are doing well in finance, and that's because it's a fundamental technology that supports our activities. You just mentioned one of many different kinds of careers in finance. In my book, Finance and the Good Society, I try to list pretty much all of the different careers within finance. But they all have some contribution to our society.
So maybe we have time for one more question. Yes, please, at the back there.
One of the really famous regulators you might know, he said, nothing good has come out of modern finance except an ATM machine.
Yes, right.
What is your take on that? And like, what
Volcker,
kind of
right? Paul Volcker.
Yes.
Yeah. Well, he was just here, wasn't he? Yes.
Yes.
He didn't say that, I hope.
And also, what do you think? What major financial innovation do we need to stabilize this chaos in the financial markets that we have around the globe?
Well, first of all, the chaos in the financial markets is swamped by the advantages of finance. We see a revolution in the world. Most of the world has been undeveloped, and now we see rapid economic growth throughout the developing world. And this is a miracle that's bringing people to civilization. That is, people who were in abject poverty are getting educations, are getting nice homes, are getting health care. And finance is really behind this. This miracle of economic growth coincides with financial capitalism. So I think that any system that has great power has potential for mishaps, and this financial crisis was one of them. But it's of secondary importance. Did I answer your question?
Paul Volcker.
You want me to comment on Paul Volcker? Paul Volcker is one of the people I admire most. I think that he is a historic figure in finance for the influence he did when he became Fed chairman in 1979 to end the binge of inflation that was spreading all over the world. We had inflation increasing year by year until double-digit ranges in the United States, but it was also in Europe. Latin America, it was completely out of control. He, I think, led the campaign to rein it in. And we've actually got it under control for a while. I'm not so sure that it will go another 50 years under control, but it is now. So I think he's a man of character, and he speaks from gut intuition. That might sometimes oversimplify, like the Volcker rule turned out to be more complicated to implement than Volcker seemed to expect, because the issues are very complicated. But I admire him as I always admire people who seem to be driven by moral impulses and their own sincere intuition, and that's what he has.
Well, I hope you've all enjoyed the past hour as much as I have. I want to thank you all for coming and hope to see you upstairs in a few minutes. But most of all, of course, I want to thank our wonderful colleague, Robert Shiller, for spending the hour with us.
Thank you. Thank you. I'm not used to this.
So I've just been reminded what you should do is grab a drink upstairs and then come back downstairs to the Bekenstein atrium. Thank you very much.